Okay, so chapter 20, forming and operating a partnership. We spent quite a bit of time dealing with various issues here, and there's probably more working parts here than some of the other chapters that you want to focus on. The first concept, though, is really when you form a partnership, what happens? Unlike what we learned about C corporations, this is really forgiving. You can have a lot of situations that would otherwise be taxable to a C corporation on formation that will just escape it, and the gain or loss will be deferred into the partnership interest of the partner. A couple of the terms that are really important to remember: outside basis and inside basis. And we use those pretty frequently throughout this chapter and the next one as well, chapter 21. But outside basis is a partner's tax basis in their partnership interest itself. Reflects kind of an NTV like decision. Inside basis is a partnership's basis in their own assets. Now, at the start, when you form, if there's no debt involved, those two are going to be identical because there's substitute basis on the outside and carryover basis on the inside. You contribute property with a $10 value or a basis with a $30 value. You're just going to get $10 of basis in your partnership interest and $10 inside the partnership assets as well. There is no control test here like there is in C Corps. We don't ask, hey, is there 80% or greater and vote and value. We don't care about any of that. A couple of other things to point out. Remember, on a partnership, there is no APIC, there is no common stock, no treasury stock, no dividends paid. Each partner is just given an account for equity just called capital. And that capital is sort of like a cumulative amount inside that represents the equity of the partner. Another thing that's important to recognize is we can keep the partnership books on different methods. We can keep them according to GAAP, according to tax basis, or these fair market value books. And what we focused on, particularly through the cases, was just doing two of them. The fair market value we didn't worry about. We either did tax basis or we did GAAP. And we try to contrast the way those worked in between. But again, generally speaking, the built-in gain or loss, it's both, if you qualify, is going to be deferred and sort of baked into the basis of your partnership interest. So what is a partner's initial basis in their partnership interest, or in other words, in their outside basis? Well, it's going to be the substitute basis of what they contributed, so it's a carryover, plus you're going to subtract, I should just say not plus, but you're going to subtract your debt relief that you're being relieved of. And we did that problem with Cosmo and Class and some other things, but it's where the debt's sort of taken away from you, the partnership's going to assume it. But then you add back in your share of the partnership debt. Now, in terms of proper order, we'll see in a moment, there's 4 basic steps. The first step is you increase your basis by the amount of property contributed, cash and or prizes, plus your share of deemed capital contributed, which is your share of debt that the partnership is allocating back out to you. Then we're going to, in the second step, increase your basis by any operating income for that year, tax-exempt income included, capital gain income, that sort of thing. Then we're going to subtract your basis in the third step by the amount of cash distributions, property distributions, and deemed cash contributions, which would be where they take debt away from you, or your share of debt from the beginning of the year has gone down. Now, this is critically important because the ordering is important. If I contribute property where, let's say, I have debt in excess of basis to a C Corp, I'm going to be taxed on that. If I do it in a partnership, as long as the debt that I get back from the partnership being allocated in that first step that we talked about, the deemed capital contribution, as long as that is pretty much that combined with my tax basis, what I'm getting, as long as that's greater than the debt that's being assumed by the partnership, I can defer my gain. So the thing to point out here then is well, how does debt allocated? That's kind of a key concept because you can see it drives a lot. Well, we break it into 2 categories, recourse and non-recourse. Recourse is simply the debt that a partner or one of the owners, one of the partners could be personally responsible for, as opposed to a non-recourse debt where no one partner is responsible. And for our purposes, we just said we're going to allocate the recourse debt based on the partner responsible for paying it. And rather than making you figure out the the complications that exist if there's multiple people, multiple partners guaranteeing debt. We're just going to tell you, hey, if there's one partner guaranteeing it, they get all the recourse debt. If there's more than one partner, we'll just say they split it equally or something like that. Now, on the non-recourse debt side, there's three basic rules on how to allocate it. We only have you deal with two. The general default rule is most of the time what you're going to be dealing with, which is if you have non-recourse debt allocations, it just gets allocated to partners according to profits interests. If, on the other hand, at the time of contribution, a partner has debt in excess of their basis, whatever that excess piece is, not the whole debt, but just the excess, that is allocated back to the contributing partner. And there's logic behind it, logic behind or beyond the scope of what we talk about. So we're not really going to get into it. Just have that in your notes that those are the two ways that you approach it. And I think you'll be in good shape. But the key here is you got to be able to identify what's recourse and what's non-recourse. Okay, so here's what I referred to. Here are the steps. Now, keep in mind a couple of things. After you've increased your basis for the 2+ items, this third item, actual or deemed cash distributions, if at that stage you go below zero, in other words, let's say my basis between step 1 and 2 is $100,000, but I got $125,000 of cash. Well, to the extent that I'm below zero, I have to pick that up as capital gain immediately. I can't go below zero on step 3. Step 4, on the other hand, I can go down to zero, but I can't go below that. But rather than picking up gain, when I have losses, I simply have to suspend them, meaning that I can't use them. I don't deduct them. I just kick them forward to next year where I wait for basis, and I can get basis several ways. I can put capital in. I can guarantee more debt. I can have earnings from operations, but until I get more basis, I can't take those losses. Another subtlety to point out, particularly as you contrast that with the S-Corp rules, you notice here that in the steps, share of non-deductible expenses, that comes out first before the share of ordinary deductible items or separately stated deductible items. That matters because if you have basis enough to take non-deductible expenses, that's great, but you can't deduct them anyways. So it's kind of a disincentive. The partnerships work this way as contrasted with the S-Corps. These are the default rules for the S-Corp adjustments. The difference is, as we learned in S-Corps, you can actually invert these with an election, which everybody pretty much does. Okay, so these are the rules that we follow on our adjustments. Now let's deal with some of the other auxiliary items. Contribution of services. We made a distinction between a profits interest on one hand and a capital interest on the other. A profits interest is just a partner's rights to future profits of the partnership. They don't have any rights today. They just have rights in the future. Said differently, if I were to liquidate the partnership immediately after giving you a profits interest, you would be entitled to nothing. Well, then you have a profits interest. And the IRS since 1993 has just agreed with taxpayers simply not to try to put a value on it. No one tries to pretend that it doesn't have value. It's just we all say we just can't get the number with any level of accuracy. So let's just agree it's zero. And the partner himself or herself will pick up income as you go along through income allocations of the partnership. So as the partnership makes money and allocates any earnings to that partner, that's how they're going to pay their tax. And that comes out to them in character as it's earned. So if the partnership is only earning long-term capital gains, the partner has a 10% profits interest, that's what they're going to receive. Okay. The other one is a capital interest, and that requires immediate income taxation. And that's because if you were to liquidate the partnership immediately after giving someone a capital's interest, they would be entitled to a share of the liquidated proceeds. So that's how you can tell if it's a capital interest. You just say, all right, you just got something. If we shut this down right now, immediately, do you get anything? If the answer is yes, it's a capital interest equal to the value that you'd receive in liquidation. And when it comes out that way to the partner as a taxable event, the other partners that are sort of giving up their capital get a reciprocal deduction. They get a deduction because they're giving up capital, and the other partner picks up income because they're getting a capital account. Okay, so elections are typically made at the partnership level. It's an entity type format. Required year end, um, you have three rules. If you can get more than 50% of the partners with the same year end, you use that, which is for most, because most are individually owned, so they're 1231. If you can't get that, you look to the principal partners, those that own greater than 5%, and all of those have to be the same to get that test done. Or if you don't do that, then you do this little convoluted formula to say, look, theory, I want to find the year end that results in the least amount of deferral amongst the partners. And again, there's an example in the book that will help reinforce this, but we're not going to be tested on the mechanics. You won't be asked to actually have to go through and do it, but you should understand it in theory that you know what it's trying to accomplish with the percent that's owned plus how many months are deferred. The partnership files a 1065 and a K1. They have ordinary business income for like the line one on the Schedule K. All the other items are separately stated. Remember, we talked about the K1 is the mechanism that is given to a partner to report their share of all the individual items. All the K1s added together equal the entire Schedule K. So the Schedule K is the partnership's total of all those items, and the K1 is the broken out amounts per partner. Okay, what goes on the Schedule K and K1 as a result are separately stated items. And these are items that could impact a partner differently. And we have a couple examples in the book that list these items. I think that's the easiest way at your level to just keep them straight, is just to kind of have a running list that you can utilize off of your 8.5 by 11. But basically, if it's any kind of an item that could potentially have an impact to the partner, it could impact one differently than the other, it's separately stated. Now, the nebulous guaranteed payment that we discussed in class. Remember, a guaranteed payment is an allocation of income from the partnership that essentially goes to one partner to compensate them for services. So partners can't be employees. They work for the partnership to make a wage equivalent of $100,000, and the partnership has $500,000 of earnings. What happens is the $100,000 is taken out of the 500 and put aside. The 400 that's left is divided, let's say 50-50 amongst the two partners. And the 100,000 that was put aside is now brought back in and is allocated specifically to the partner that provided the services on their Schedule K1. And they'll report $300,000 of income, 100 of guaranteed payment and 200 from the ordinary income. And the thing that's important about the guaranteed payment is guaranteed payments are always subject to self-employment tax. Okay, so that brings us up to the next question that many of you are asking, which is, okay, well, tell me again how that worked with the rest of the income. All right, if we have business income of a partnership, what's subject to self-employment tax? Well, the answer is if the partner is working there full time, then it's kind of beyond a question. All of their income from the distributive share from the operations plus their guaranteed payment would be self-employment income tax. If, on the other hand, they have nothing to do with the entity and they're not a general partner, then none of their distributive share, their ordinary income, would be subject to self-employment. The question is, what happens if they're in between? And we talked about these proposed regs that said, well, if you combine the partnership or you work more than 500 hours, try to define how much is too much activity. If you meet those rules, that's when you start saying that the service is going to assert that you got to claim self-employment tax. Okay, we talked just a minute ago about loss limitations at the tax basis limit level. So let me show you that again. So remember, if you're here, you get your losses suspended here on this last step because you don't have enough basis, then what we're going to discuss doesn't apply. We're going to assume that you've gone through this entire setup, that you have losses, and you had basis to take the losses. Okay, now the question is, what do you do with them? Well, remember, we had the bucket O loss. We have three categories. We have tax basis, at risk, and passive. And we said that the tax basis limit you got to qualify for, and then it goes, if you do whatever can get through there, it goes to the at-risk limitation. And the at-risk limitation, the difference between that and tax basis is that some of the debt that you get credit for tax basis, your outside basis, won't qualify for at-risk because you're not truly at risk for it. And this would be your non-recourse debt. Now, there's a category of non-recourse called qualified non-recourse financing or debt that deals with real estate, and I would have to just tell you if that existed. The regs are a little cumbersome to decide how much is enough activity in real estate to make it that, but suffice it to say, if you have just pure non-recourse debt, you'll get tax basis for it, but you won't get at-risk basis for it. And that means that you'll have less of a chance to get those losses through because it could get suspended at that level. But let's say you get through at-risk, then you get to the passive loss rules. And remember, the passive loss rules just simply say that you've got to be materially participating in the entity to take a loss. If not, you can't. You could take a loss only when you find one of these so-called PIGs, passive income generators, so passive income from another source, or you can also take a loss if you get rid of that activity that generated the loss, just sell it, whatever, or that activity in the future may become active because now all of a sudden you start getting active in it, doing things, so it's materially participating. If that's the case, even though you're materially participating and it's kind of in a different category now, you can go back and offset losses from the same activity. Okay, so there we are. Now, again, let's be really clear here. There's a lot more detail under this general overview, but this gives you a sense of what we discussed and it'll help you focus, I think, your attention as you flip back through the chapter. Again, if you have any additional questions, please feel free to let me know and good luck in your studying.